at the moment to sort of disentangle the pay story. For the reason that in this country, a year ago, average earnings were negative, which is it's an unusual event. But of course, it means that the percentage increase from then to now is much higher. And I've said a few times actually in the last few months that if there was no increase in pay in this country for the rest of this year, we would still have pay growth of 8%. And that's a big number by any normal or historical standard. So you have to put it in that context. The second thing is that the composition of who's in the pay growth statistics has changed. There's a compositional effect that the people who are in the pay growth statistics at the moment are people who tend to get higher pay increases. That's because of COVID. The impact it's had on people, the lower paid people, particularly in service sector. So again, you have to sort of factor that in. Now, we've done our best to sort of take all of this apart and say what's going on underneath. And yes, there is reasonably robust pay growth. The big issue at the moment is that we've got an increase in vacancies. And we need the labour market to now start bringing people coming back into the labour force and filling those vacancies, because if that doesn't happen, we will get paid.
There could be a mismatch, yeah. Let's talk about the policy guidance review. A question I asked you in the press conference, and you articulated very clearly that one should not perceive the balance sheet reduction to be a substitute for rate hikes.
Yeah.
Why is balance sheet reduction a priority right now? Why are you so focused on it, and why did you make this announcement today?
Well, my view, by the way, of course, today we've not announced that we are reducing the balance sheet. We've
of course, you've changed the guidance. Yeah.
And I think it's important to give, to make that predictable, to give a degree of certainty to how we will respond to that. I also think, as a central bank, of course, we're not alone in this. I mean, other central banks are in the same position. Our balance sheets have expanded very substantially as a result of the necessary actions we've taken in terms of asset purchases. Our balance sheet is, I think it's over 40% of UK GDP now. By historical standards, that's very big. Now, we may have to do this again if we get some unpredictable shock in the future. And if we're going to use this as a tool of counter-cyclical economic policy, which we have been doing, then I think we have to be very cognizant of the size of the balance sheet. And we have to manage the size of the balance sheet more counter-cyclically. So we have to have in place policies that say, during the good times, during the recovery, here's how we will reduce the size of the balance sheet. And for me, that's very important, because I've got to plan for the future about how we meet unknown future events. We've had two very big shocks in the world economy in the last 15 years. We've had a global financial crisis, we've had a pandemic. I mean, one of the big messages for me out of that is we've got to be prepared. We don't know what's going to happen, but we've got to be prepared for things to happen.